Okay, so good morning and welcome. We still have some folks registering downstairs, but given our time constraints and the amount of topic we have to cover today, I thought we'd just get started. I'm Frank Verastro. I'm a Senior Vice President here with the Energy and National Security Program, and it's my great pleasure to welcome you here this morning. This is a discussion we've long been looking to have. So actually, let me get two administrative things out of the way first. The first is safety, because safety first, and you're all important to us. And today you're lucky because myself and my four colleagues, Adam, Sarah, and Guy Caruso, will have double duty as moderators and safety officers. So just for the purposes of orientation, we don't expect any evacuation, but just to be on the safe side, two exits from this building or from this venue, down the stairs, out the front door, the way you came in, and we gather across the street to the right of the hotel, or follow the exit signs at the elevators behind me that takes you to the alleyway behind the building, takes you out to M Street and by National Geographic, okay? Second thing is phones. We've got a good-sized audience here today, so out of courtesy to the folks next to you and also to our speakers, if you put them on vibrate or turn them off, you can always step outside and get caffeinated, hit the restroom. We'll build in breaks throughout the day. We've allowed for extra time, but because of the substance here, we wanted to make sure everyone's question was answered. So over the course of the past year, we've got a series of expert workshops on this topic. We've looked at oil and gas in the United States, the impact on both local and globalized markets. We've looked at challenges, whether they're community, societal, regulatory policy changes, and how that could impede that production, what that would look like. And then at the end of last year, we actually held a session specifically to look at the Permian and the Scoop Stack. And this whole issue of the rise in U.S. production, how quick, how large, and what are the impacts on global markets, has been in the news almost every day. When you look at the most recent forecast, actually talks about how U.S. production growth, and the range is enormous, from 700,000 to 1.6 million this year alone, how that could actually overtake or take care of demand growth for the next year without OPEC. So we're going to put some boundaries on some of these projections and qualifiers. We want to examine what the assessments are, the range of assessments, but also the assumptions that go and underlie these assessments. And we'll talk about things like offtake of natural gas. I know Rusty's going to talk about that, how that would impact Permian production rates. We'll talk about productivity, technology changes, cost reductions, the ability to finance. There was a discussion we had earlier with someone on the second panel that talked about financial discipline in 2018. And does that mean 125% of cash flow as opposed to 180% of cash flow? What does that look like? And how do you stay in the game and pay for this going forward? Is it value versus volume, or are we really in a different place? In terms of the export market, we will also spend some time looking at what U.S. light oil, tight oil, looks like in a global market. So except for summer burn, in most cases, crude oil is sold to refineries. What does it displace? You know, we talk about where we are in Iraq production, Libyan production, Nigerian production, and yes, Venezuela. But U.S. light oil is replacing, all refiners can use it, but it affects their product slates and the economics of their refining. So we'll spend some time looking on that. We will also talk about things like frac kits. So lessons learned over the past decade, right? Well interference. We're drilling tens of thousands of wells. What does that look like in the field? And I've got to tell you, in terms of the expertise of the panelists, when we started talking about this, I was speaking to Rusty just before, scheduling these speakers, we did it 5 or 6 months in advance. Times are real busy. We wanted to make sure that we had the right speakers to discuss these topics. So today, we think that we've put a great group before you, and besides the built-in time for grabbing lunch and also networking, we want you to have the ability to talk to the speakers, and so we can have some interaction. And when I look at the expertise in this audience, I actually think we're going to have quite an invigorating discussion. So in your program, there's more detailed bios of each of our speakers, but briefly, let me kick off our initial panel, and I'll introduce our first panel of speakers, Artem Abramov, R.T. Dukes, and Robert Kleinberg. Artem is Vice President of Rystat's Energy Shale and Well Data Research Team. He's responsible for empirical analysis of well production profiles, their completion techniques, and economic indicators. In his spare time, he manages the company's shale well database. And we've asked Artem to do some stage setting, talk about the current state of play with respect to technology and operational improvements as a prelude to what future production profiles might look like. And in that context, he'll also touch a little bit on constraints, production constraints. Our next speaker will be RT Dukes. RT serves as Director of WoodMac's Lower 48 Upstream Research effort. He's got experience in the Rockies, the Bakken, and the Haynesville shale. He's also spent considerable time evaluating the impact on unconventionals growth for both local and global markets. And he'll take us through the basics of Shale Algebra, about key drivers and why the resource could over or underperform. Bob Kleinberg will wrap our panel up. Bob's a frequent presenter here at CSIS. He holds the distinguished and rarefied title of Schlumberger Fellow. So he's one of about a dozen or so out of a workforce of 100,000 that are designated as just fellows. He can basically do what he wants. He's authored more than 100 academic and professional papers. He holds 30 patents. And true to form, we've asked Bob to be a bit more provocative and forward-looking in terms of areas of the next phase. What can we expect from the next phase of technological improvement? So we'll get into that. It's our pleasure to welcome you here today. We look for an informative discussion. Again, we will build in some extra time as we go forward. But Artem, I'm going to ask you to come up here and start us off. And thank you all for joining us today.
Good morning, everyone. Thank you, Frank, for this really great introduction and nice opportunity to begin our discussion today on the US oil production forecasts. I'm here with Rystat Energy. For those of you who don't familiar with the company, Rystat Energy provides business intelligence and products and databases for the E&P industry, oilfield service players, and also financial community. In case of our US part of the business, we do everything bottom up. So we start from governmental disclosures, we look at the individual well details, and we put it into the context of the company communication on both E&P and oilfield service sides. So today I'm going to share with you some of our latest observations with respect to how efficiency gains are evolving, well productivity, what kind of changes we observe from the well configuration side. But I will, of course, start with the main topic for this panel. Is basically our latest US oil production forecast. So in this chart, we are looking at evolution of our US oil production forecast since early 2017 to the most recent one, which was just published basically a couple of days ago. We last year, Rystat Energy, we were fairly consistent on our exit 2017 and exit 2018 projections. So essentially, even before early guidance from E&P players, from operators was published in 2017, we saw that 9.9 to 10 million barrels a day wasn't really on the horizon last year. So this is something that we published in early February 2017. This figure was revised slightly upwards. As we know already now, a significant 10 million barrels a day milestone was really reached already in November 2017. What is really important right now, with all the bottlenecks on the service industry side, with all the discussions about frac hits, some degradation in the well productivity in certain areas, and with certain degradation in the sentiment on the financial community side, we still think there will be no problems this year for the US oil production to continue grow, maybe not at the pace which we observed in the last 4 months of 2017, but at average pace of 100,000 barrels a day per month. So essentially right now, we think that 11 million barrels a day will be reached in early Q4 2018, and there are so many downside risks which have to materialize simultaneously in order for this not to happen. As we move in 2019, of course, any discussions about US oil production projections are dependent on our price view. In our base case, where we see WTI averaging at 65 USD per barrel this year and 61 USD per barrel next year, we think that this growth pace will actually be maintained. So we actually expect US oil production will reach 12.5 million barrels a day We often hear that everyone discusses the latest trends in the Permian Basin. Essentially, there is a common theory right now that shale story is the same as Permian Basin story. We don't think this is actually the case. If you look at cumulative production change in some major basins, how it since peak in April 2015, that was the peak in US oil production prior to the most recent one, then you can see that not only Permian Basin, which was of course the major source of growth, but also Bakken and Niobrara and Anadarko, which are grouped together on this chart, exhibit quite significant recovery. Some people say that Scoop and Stack, which is part of Anadarko, and DJ Basin in Colorado, is just a rounding error on the total US oil production projections. We actually don't think this is the case. And if you look at combined cumulative additions from this place, we are already talking about 230,000 barrels a day growth over 12 months in 2017. So it's quite significant contribution coming from these minor basins, and also Bakken, where activity was really revived last year. This significant growth, of course, came together with significant recovery in the activity. So a couple of key activity metrics which we track is the number of wells. Number of wells which were drilled, quarter by quarter, red columns on this chart, and the number of wells which were fracked and became capable of production, basically the wells which were completed in different quarters. So drilling activity generally followed the rig counts, even though we observed a certain degradation in the drilling efficiency last year, but more or less we are talking about 150% recovery in the drilling activity since the bottom in mid-2016. There was a temporary slowdown in late 2017, last month of 2017, but already now, in the most recent weeks, we start getting quite significant rig count additions in the most productive place, like Texas part of Delaware Basin, for example. Completion activity, it just exhibits a natural delayed recovery relative to the drilling one. You have a typical cycle time, which varies between 4 and 8 months, depending on the basin. This is a typical time from spud to completion in different places. And if you look at this chart, you will largely see that completion activity was just recovering with this normal 2-quarter lag relative to the drilling one. So despite all these discussions about service industry constraints last year, pressure pumping capacity, we didn't really see that it had a very significant impact on the pace of recovery in the completion activity. But of course, everyone talks about the inventory of drilled uncompleted wells. Indeed, if you just look at it from pure definitional perspective, we already have more oil, horizontal oil DUCs, drilled uncompleted wells in the inventory than we had back at the peak in 2014. However, as a standalone topic, one thing which we normally try to stress as a standalone topic, any changes in the DUC inventory, they're not really important. DUC inventory always changes relative to overall activity level, drilling or completion activity level. Due to this typical lag of 4 to 8 months from spud to completion, DUC inventory always increases when drilling activity does so. So the way we prefer to look at the DUC inventory, we prefer to look at the share of old wells in the total inventory. Of course, this threshold, what is old well and what is new, is a little bit arbitrary, but if you draw a line at 7 months, let's say if you look at the share of the wells which was spudded more than 7 months ago to the total contribution into the DUC inventory, then this is the picture which you get in different basins. And you can see that there was nothing abnormal actually happening in 2017. We more or less returned back to pre-downturn level of around 10 to 20% in most of the basins. In fact, it was 2015 and 2016 when we had several major players like UOG, Anadarko, Continental Resources delaying some of their well completions intentionally. This was the time when the share of abnormal DUCs actually peaked at the level of 50 to 60% in many basins. It was only last month of 2017 where we observed a certain abnormal DUC buildup in some Texas places, like Eagle Ford and the Permian. And this had to do a lot with some service capacity constraints. But if you compare it to the historical levels, it is nothing. It isn't just not significant. Then I would like to have a quick look at the latest changes in the well design, well configuration. This is, of course, just a bottom line. There are a lot of dynamics happening in each play, but there are, you see just a couple of key metrics which we track. On the top chart, we're looking at the evolution of average lateral length, perforated lateral length, how it evolved quarter by quarter in the major basins. And on the bottom chart, we are looking at the proppant intensity, amount of frac sand per lateral length foot. So if you look at lateral length, the stories are very different from one basin to another. So Bakken is a liquid play where 2-mile laterals was already something standard back in 2011, 2012. So we didn't see too many changes. However, even in Bakken, we now observe that Continental, they started doing 14 to 16,000 feet laterals on all their wells when unit spacing basically allows to place such lateral. Also, ExxonMobil tested some 3-mile laterals, and a couple of other smaller players tested 3-mile laterals. We actually think that as we move into 2018, even though it's too early to conclude on the impact on the well productivity and, more importantly, break-even prices of such well design, but we expect that more dedicated Bakken players will start testing some such well configuration. So basically, as we move into 2018, we would actually expect a certain growth in average lateral length even in Bakken. If you talk about other plays, in general, what we observe is overall activity shift from the test nature to the development phase, like full-scale development activity. In the development phase, you would rarely see lateral length below 1.5, in some cases 2 miles, if unit spacing basically allows to place such lateral. And this is more or less exactly what is happening. In Delaware, also in Midland, in Stack, more and more operators, they shift to the development phase of activity, pushing average lateral length upwards, but essentially just a shift in distribution. You have fewer 1-mile laterals, and you have more 1.5 and 2-mile laterals. Proppant intensity is a little bit more complicated because optimal proppant loading is always a function of the proppant prices, proppant costs. Essentially, when you increase proppant intensity by 100%, when you double it, your well productivity never increases by 100%. In most cases, it increases by 10 to 20%. What it means is that there is always an inflection point after which it is no longer beneficial to pump additional pound of sand because it doesn't generate sufficient uplift on the well productivity side. So back in 2015, 2016, it was more or less a no-brainer. When proppant prices collapsed, it was a no-brainer in most of these places to increase proppant intensity. However, as we moved into 2017 and proppant prices increased by 60% compared to the bottom in 2016, some operators, they actually realized that they passed this inflection point on the proppant intensity side. So they actually stepped back a little bit. For example, in Stack, we saw quite many operators doing it last year, but we still observe quite a lot of laggards, basically quite a lot of companies who are lagging behind the optimal proppant intensity, optimal loading, and they push average upwards. So that's why in recent quarters, proppant intensity has been evolving in so-called flat manner in most of the places. As we move into 2018, we would actually expect that proppant intensity would start growing again in many of these basins. The main reason for that is quite rapid, is that we expect quite rapid substitution of expensive northern white sand from Wisconsin and Illinois with in-basin sand from West Texas mines, particularly in Permian Basin and Eagle Ford. So as more and more of such mines come online around mid-2018, operators will actually see quite significant pressure, downward pressure on the proppant prices. It's around 40 USD per short ton, a saving which you realize if you switch from northern white to in-basin sand in Texas. So some of them would start experimenting with even more intensive loadings, and basically we wouldn't be surprised if average proppant intensity would trend toward 2.5 thousand pounds of sand per foot in most of these Texas places. And just to support the idea that we are still in early days, on the well design side, it is still all about test activity in many quite significant places. On this chart, we are looking at eastern Delaware trends. So it's basically the eastern part of the Delaware Basin, primarily Loving, Winkler, and a couple of other counties. And on the x-axis, you see the completion date, and on the y-axis, it's lateral length, perforated interval. And every single dot corresponds to individual wells. So we have all horizontal wells, most of them upper Wolfcamp wells, which were completed in Permian Delaware, in eastern Delaware in the last 3-4 years. And you can see that it was only in early 2016 when operators actually started, some operators like Shale and Anadarko, for example, they started shifting towards the development phase of activities. So you started getting some dots in 6,000 feet plus range. But even when we look at 2017, we still have a lot of players, who are experiencing lease structure constraints. Sometimes it's impossible to drill long lateral. We observe a lot of acreage swap activity as operators try to consolidate their acreage positions. So there is still a long way to go. But most likely, in most of these areas, we'll see development lateral configuration of around 2 miles. So there is a long way to go on the well design side. When we look at the well productivity, so this is again just the bottom line, average first year oil decline curves in major liquid plays by vintage. The red and blue lines correspond to the 2 most recent years, 2016 and 2017. You can see that we still observe quite systematic improvements in the well productivity in most of these plays, but the stories, they're very different for this place. So in fact, it is Bakken, fairly mature Bakken, where we observe the most significant improvements on the well productivity. However, in the Permian Basin, in both Midland and Delaware, we didn't really see any extreme improvements last year. But the reason for that is a portfolio effect. Last year, quite significant activity in the non-core parts of the Midland and Delaware was revived. And some operators, some acreage positions with less productive, less efficient wells, they started contributing more to the total activity. So essentially, when you look at these high-level average curves, you don't really get the full story. When we look at productivity improvements at acreage level for some well-established players in Midland and Delaware, we often observe more significant improvements, even among those who actually shifted to infill well completions completely. The ultimate metric of the well commerciality is the break-even price. Sometimes you get high well productivity, but also it comes at the cost. Basically, it comes together with a higher cost, drilling and completion costs, which is particularly important now when everyone talks about quite significant service cost inflation, which might hit the industry this year. And early signs, they were visible already last year. So that's why what we do, we look at the ultimate metric of well commerciality. It's basically the break-even price. And on this chart, we are looking at 50 really large shale oil acreage positions. So you have the company name and you have the basin on the x-axis. And the orange dots, they show typical, basically break-even price for a typical well. It's a median across all wells completed in the last 2 years. And you can see that all these orange dots, they're actually below 50 USD per barrel. So they are in 60 USD per barrel environments. All these operators, they're able to realize very good returns on their wells in these acreage positions. So our key message here is that even if we expect quite significant service cost inflation, particularly on the pressure pumping market side, we actually observe that E&Ps, operators, they're able to accommodate for this cost inflation. So we don't think that this year, service cost inflation will actually act as a certain showstopper on the activity and production expansion. One very important topic which is often ignored is the base decline, basically the pace at which production falls if you stop completing any new wells. And in case of shale, it is actually quite important because it changes. It is very dynamic. It changes quite rapidly when overall level of activity changes. So back in 2014, in late 2014, base production was falling by 50% over year one and 66% over the first 24 months. So it was very difficult to offset this base decline with new production additions when activity collapsed. But when activity collapsed in 2015, 2016, we immediately started getting fewer wells, new wells with steep decline rates contributing to our base. That's why base production became significantly more mature. And in late 2016, base decline actually was reduced to the level of only 1.6 million barrels a day in year one. So that's why in 2017, we didn't really need significant uptick in the activity in order to observe abnormal production additions, which materialized in late 2017 over the last 4 months. However, this growth, again, came at the cost. So right now, we are back to the situation where we were in late 2014 in terms of base decline in absolute volumes. So we need to offset 3.1 million barrels a day of horizontal oil production decline in the next 2 years in order to maintain flat production. However, already now, current activity is at such high level that is significantly above this balancing point, the number of wells which is needed to maintain flat production. So it's why we actually think that there will be no problems, as I mentioned in the very beginning, for shale production to grow by 2.8 million barrels a day from December 17 to December 19. And what is quite scary from my perspective is that this growth doesn't really require significant expansion in the activity, in the completion activity, from the level where we are already today. So if you look at this brown line on this chart, which shows the number of wells completed month by month behind this production forecast, we actually only need to see the growth by 40% from Q4 17 to Q4 19. We think it will be very difficult to grow faster than that due to all the constraints we have on the pressure pumping side, and I will mention some of them just in a few slides, in 2 slides from now. But this growth can absolutely be delivered within currently announced plans, currently existing plans of all service providers and E&Ps. So this year, we're getting 2 million horsepower of new builds on the pressure pumping side, which will basically be sufficient to lift the activity level by 25–30% from where we are already today. In addition, we have some service providers who still have some capacity in their cold stacked equipment. We have, for example, Schlumberger, who plans to reactivate all Weatherford's frac spreads. Some people don't believe that they were properly maintained, but I know that Schlumberger is very confident on their plans to reactivate them. So we have some of this capacity, and we have Halliburton with a very disciplined approach who knows exactly how they plan to reactivate their remaining cold stack equipment. In terms of sensitivity, one thing which I mentioned in the very beginning, of course, oil production forecasts for shale, they're very dependent on the oil price projections. And if we look at our December 19 projections, we actually have a difference of 1.6 million barrels a day between 50 USD per barrel flat WTI scenario and 70 USD per barrel flat scenario. But what is really different from the situation where we were back in 2014 is that now we think that shale production can grow quite comfortably, not only in the short term due to the inertia, but also in the medium term in 50 USD per barrel world. So even in 50 USD per barrel, we are talking about very significant additions which will extend into early 20s as well. However, if we talk about the additions on top of our base case, basically 70 USD per barrel scenario, they are very limited. There are so many bottlenecks on the service industry side, that's why it will be very difficult for the activity to grow faster than what we already project in our base case. And just to mention a couple of bottlenecks which are very important and probably they're the most significant, these are the bottlenecks which might prevent some of these projections from happening. First of all, it is a takeaway capacity in the most active basin, the Permian Basin. So on this chart, we are looking at the dotted line, which is our US oil production, Permian Basin oil production projections for the Permian quarter by quarter. And then you have all the existing pipelines, all future announced pipelines, and then you have local refining demand, which is fairly small in the Permian, and very small volumes which are actually transported by rail. So as we move towards late 2018, you can see that the dotted line nearly catches up with total takeaway capacity in the Permian Basin. So the second half of 2018 looks very tight. We don't really have any major expansions, some new major pipelines, which will come online before 2019. So we would definitely see quite significant degradation in differentials in some areas of the Permian Basin. We actually see them already now in some areas, primarily on Delaware side. As we move towards 2019, we think that it's an absolute requirement that EPIC pipeline comes online as scheduled. If this doesn't happen, it will put quite serious constraints on the pace of Permian Basin oil production growth. Other bottlenecks, they come from the service or supplier side of the industry. the most important market probably on the supplier side is the proppant market, because with all this growth in lateral length, proppant intensity, already last year, US land consumed more proppant than back at the peak in 2014. This year, Texas alone, Permian and Eagle Ford basically, will be larger than total US back in 2014. So it's a very significant expansion. We are still in very early days of the growth in the total proppant demand, proppant consumption. By the end of the decade, we expect that the total consumption will reach 170 million tons per year. There are many bottlenecks on the supply side. Now we're getting all these in-basin mines which are coming online. In-basin sand will start replacing quite significant share of the northern white sand from Wisconsin and Illinois. So the structure of this market is changing quite dynamically. So if you compare 2014, when northern whites corresponded to 75% of the total consumption, proppant consumption, already this year, the share of northern white is declining to 54%. Of course, the sizes of these bubbles, they're very different. 2018 is much larger. That's why some of the proppant suppliers who are biased towards northern white part of the market, they do not necessarily expect significant downward pressure on the northern white prices, just because overall demand expands so rapidly. But there will be certain downward pressure. There will be quite significant substitution in Texas place, and operators will eventually eliminate transportation costs from Wisconsin to Texas from the entire supply chain. So there will be some cost deflation this year in this segment from operator perspective. But one bottleneck, which is probably even more important than the supply side of the story for the proppant, is the road infrastructure and the labor situation. So if you just look at this chart, which shows you average number of trucks with sand per day in the Permian Basin alone, then you can see that in 2014, 2016, we were in this very comfortable range of 1,200 to 1,300 trucks per day. Already last year, this number more than doubled. And this year, it just continues growing further. And this is very important because when we look at some of the highways in Midland and Delaware today, there is simply no more space to insert additional trucks. It's just a constant traffic. And road infrastructure is not something we can develop very quickly. We can upgrade very quickly. So it takes time to develop new infrastructure. So ironically, this might become the most significant bottleneck as we move towards the end of decade, which will introduce some additional delays in frac operations, and basically which will prevent some of the activity, growth in activity from happening. And second part of the trucking bottleneck is the labor situation. Right now, it's very difficult, to find for proppant suppliers to find truckers who are willing to move to West Texas. More or less everyone highlights it as the most significant bottleneck. There are some new regulations which will be also reflected on the cost side of the story for proppant suppliers. So essentially, suppliers are facing quite significant cost inflation on their side. And last part of the story on the service market is the pressure pumping market. So we did this survey, we talked to all pressure pumpers, and we did this survey asking them to highlight the most significant bottleneck in the pressure pumping market. And 60% of them said that it is the existing frac equipment, basically everything that was possible to that could have been reactivated was already reactivated last year, and right now very few service providers have some remaining power in their cold stacked capacity. Well, Halliburton and Schlumberger does. This is not the case for many other players. Basically, everyone operates at the maximum capacity already now, and even those who have some remaining capacity in the cold stack part, they do not necessarily think that it was properly maintained throughout the downturn. Frac crews, again, labor is a very important part of the story. So many people were laid off during the downturn. Some of them who were the most experienced professionals actually changed the industry. They moved to a different industry. So now there is a need to hire new people, train them. But even if you do it, it is not necessarily the case that operators, your clients, would be willing to accept these frac crews. E&Ps, they actually have this tendency to book frac crews by name rather than by service provider. Basically, they say that I would like Joshua's crew to frac my wells, not Schlumberger's or Halliburton's crew. So that's why it will be a fairly significant challenge, when all these newly trained frac crews basically come into the fields to actually convince E&Ps to accept them. Finally, equipment lead times. This is about the new builds. Manufacturing industry, is experiencing a lot of bottlenecks on their side. If you place an order for new pressure pumping equipment today, you need to wait at least 6 months until this order is fulfilled. Basically, whatever comes online right now, as we speak, is based on the orders which were placed in Q3 2017. So very significant increase in the lead times. And the last bottleneck where we actually face two extreme opinions when we talk to service providers is overall attitude. There are some of them, but it is really a minority who think there are no bottlenecks who will deliver on any incremental pressure pumping demand this year. But majority, they prefer to remain quite cautious. So they still remember the downturn, 2015, 2016, when we had a lot of equipment which was overbuilt and was never used basically before. So some of them prefer to wait until they're convinced that the recovery in the prices is systematic, that the recovery in the demand is systematic, is sustainable, and this will be the time then they will really go full speed in terms of the new builds and hiring practices. So I think with all these bottlenecks which I mentioned, we basically see that there are quite severe constraints in many areas of the US oil production, but it's still a very exciting year. Both 2018 and the next year will be very exciting for the US oil. As with all these bottlenecks, we still think that the US oil production will be able to grow at the pace at least 1 million barrels a day per year, even in low 50s WTI. Just because it has already gained a very significant momentum, and this expansion will just continue in the foreseeable future. So I think with that, I will pass it to RT.
Excellent.
Good morning. RT Dukes from Wood McKenzie. WoodMac is well, I used to say I joined WoodMac when it was an energy research and consultancy. I think now we call ourselves an energy, chemicals, metals, mining, and renewables research and consultancy. I think we'll shorten that, Charles. I think that's on your to-do list. I think it's going to end up being natural resources at some point in the future. I'm one of over 600 analysts, so all those topics mentioned, if you have a question, we basically have an opinion. I started my career looking at the Barnett Shale, and I remember, I didn't maybe think it was going to be as career-defining as it was, but I remember running our economic models and saying, horizontal wells are what they should be doing in the Barnett. These last 10 horizontal wells that Devon drilled, there's no reason to drill those vertical wells. What are they doing? And within about a year from that time, they had shifted to fully drilling horizontal wells, and that was a little close to 15 years ago, 14, 15 years ago, that they began to make that decision or begin to look at those wells. And it's interesting because I've spent, probably a few years after that looking at supply. So Frank asked us to talk about why do we see these diverging views? Why are people putting out numbers 700,000 barrels a day and 1.6 to 2 million barrels a day of potential production growth from the U.S. this year? And so I've got a few, for some of you, I actually recognize, several people in the room. I didn't necessarily know I'd come to DC and recognize so many faces. So this will be elementary for some of you. You guys are welcome to ask the hard questions afterwards. But for the rest of you, wanted to cut through and show you some of the main sensitivities that we've seen over the years and things that drive the big divergence in these forecasts. I called it Shale Algebra or Shale Algebra. That's one way to get famous as a research analyst. You invent words. People remember them. So Shale Algebra, but it should probably really be Shale Calculus. It's probably a little bit more complicated than even algebra. We have a supply model. One of the guys was telling me the other day it has 16,000 inputs. Basically what we've done is build a model that when our clients have a question, well, we can say, okay, well, let me change the number, and here you go. Here's the outlook. All the inputs from all of our analysts, we can very quickly run those scenarios, because oftentimes your bias, your convictions, maybe is a more positive way to say it, drive these outlooks and really what you're doing and what you expect to happen in the future. I'll use 2014 to 2015 as an example for probably the rest of my career. End of 2014, oil prices were falling, and people were calling and saying, oil production is going to start falling. This growth is over. This growth is over. And we went, well, wait a second. We think it's going to be the middle of 15 before, maybe, depending on how bad this gets, before production would roll over and you'd start to see declines. And so a few months later, you're seeing the ramp up, and people were going, this is going to grow forever. Just in 1 to 2 quarters, people were then calling and saying, it's not going to decline, it's just going to grow forever. There's not an oil price where this tight oil stuff ever grows. And I think that's a great analogy for how we like to think. We're linear thinkers by nature. Like, we like to think in straight lines. It's just easier. It's also, from a research perspective, as we tell market messages, it's a lot easier to tell that message. It's a lot easier to say it's going up or down. It's much harder to say, well, spud to completion times were 120 days, and they've compressed to 80 days, and the downturn, and rigs are drilling 7 days faster, and so, you add 120 and subtract 7 and put it all together, and we've got a number that's 110,000 barrels a day. That's hard to explain. So a lot of times, the numbers that are behind some of these simple numbers you see in headlines are much more complicated, and there's a lot of levers that are being pulled to get there. So what we say in forecasting is you really have to think about what's the purpose. What are you trying to get to in your forecast? What decision are you trying to make? And then what are the critical factors that drive those decisions? And then you focus there. I'll get to a little bit more of that here in a minute, or towards the end of the presentation. But first, just wanted to start here with this slide. And this is just a simple way to think of the things that input how we view those economics. Not very different than Artem's chart that he showed about break-evens. We think about point forward economics, we think about full cycle economics, what goes into those. We had a view at some point a few years ago, and things changed, like technology, corporate behavior changes, service cost pressure, Artem mentioned, changes. Where is the pricing power? Is it with the E&Ps? Is it with the service companies? And all these bars move a little bit. And these are simple bars. In reality, there are lots of inputs to these bars. On the cost side, is it that those macro factors? Are you pulling equipment and capacity back into the market? Or is there excess capacity that's underutilized, like we saw a couple of years ago? Are there elements like sand that are tight or going to be oversupplied and so forth that drive these cost numbers? Well designs, something simple that we often overlook is a well design today. Actually, just the drilling design is very different than it was just a few years ago, and oftentimes more expensive and more timely. It takes more time to do it as well. And then performance. You'll hear people, I'll use some examples here in a minute of productivity, but how will these wells perform long term? What do we expect? And not just long term, what do we expect in the short term? We actually have two views. We have a view on what we kind of think the next wells in the next, call it 1 to 2 years, how they will perform, and then we have a view on how we think wells will perform over the next, let's call it 20 years in what we call subplays. And then price realizations, something like DAPL and the Bakken coming online and actually improving price realizations by real numbers. I mean, $5 when oil is 50 is a big deal for Bakken producers. And then actually, with spare capacity on the pipeline, they're actually getting a premium to WTI at one point and still a little bit close to WTI. So you look at it that way, and it was more like a $10 to $12 swing in prices for those Bakken producers. Price realization is very important. And then also gas prices. You'll see a lot of charts, and they're in the papers all the time as well on break-evens. Typically what is done is a gas price is assumed, and they're solving for the oil price that gives them some rate of return, typically 10 or 15%. Whether that gas price is $2 or $3 or $2.50 is actually a big deal, especially in places like the Permian, where there's going to be a lot of gas production. It's going to need to move out of the Permian. And if you're getting $3 versus $1.50 or something, if Waha were to really blow out, it makes a big difference in what that break even is. Maybe it's $5, but $5 is significant if you think oil is going to float in that $50 to $60 range. And then that gets you to a view in 2018. The way I describe what we do to clients as we kind of jump into the details of this, what you get from us, and I think others like us, is a snapshot of what we believe will happen in the future. We're not fortune tellers. We can't tell you a technology, some innovation is going to come that we don't know, but we can make some high-level assumptions about, on average, the best operators in an area. We would expect X or 0.98 of X, and they're typically getting 0.99 of X. To us, that shows us they're getting about 1% better per year type examples. And so this is a snapshot. So we build up from the bottom up, and it's a snapshot of what we believe can happen in the future. Next slide is, I'll jump into just an example of that. I'm originally from East Texas, so covered the Barnett early, in my career. I'm from East Texas. I managed our Rocky service, so I covered the Bakken, and then I was investing in producing interest and mineral interest when the Eagle Ford took off. And so I've kind of been in the middle of all these shale plays over the last 12, 13 years. So the Haynesville, I thought, was a good example. This is gas, so it's a little bit more dramatic example than maybe you would get in the Permian and the oil plays. But what you see here is a forecast of about 20 wells per month getting drilled. And the difference in the curves is the lower curve is real data from 2012. So let's just call it 2013, he said, well, I've got all the well data. I know what these wells will do in the future. I can be really confident in this. And this is an extreme example. I'm not saying everybody's doing this. I just wanted to use it as an illustration because even 1 year differences can make a big, you can have a big delta here. So you take that view for average well, what it produced in 2012, and you take our view of what we think wells in that exact same area, and I'm talking about an area that's smaller than a county. There are about 20 rigs in this area. It spreads over a couple of counties, but it's not quite a single whole county. 20 rigs active there today in the Haynesville. And our well expectations in just 24 months, if you use that 2012 curve versus the curve we expect today, it's over a BCF a day of production difference. The delta is over a BCF a day in an 80 BCF a day market in the U.S. So one county in the U.S., one assumption for how a well is going to perform, and you can get numbers that are that big or that diverge that much in just a 2-year period. And so you multiply that times all of the plays, and you can see very much where what you think about what's going to happen in the future is very important. Haynesville, this is one of the reasons wells are performing a lot better in the Haynesville. It's one reason the Haynesville's gone from more of a bust to boom again. You know, it's boom, bust, boom, and it and the Bakken are kind of racing to see who surpassed the prior peak in production, who can do that first. And so Haynesville's doing well again. The reverse is also true. Before I move on, the reverse is also true. I mean, reservoirs mature, and there are also places where we have type curves that get worse over time, that we think maybe the best wells are largely drilled, and you're only drilling infill wells, and they get a little bit worse. So just want to highlight that as well. Stacked pay. You know, this is a phenomenon that, you know, really in the last few years, and it's really pushed the Permian to the forefront because the resource potential is so big. Because you have a column that's so thick that you can drill so many wells that you can drive long-term growth from many different plays, essentially, or different zones within a single play. Texas is interesting in that leases, you get a total lease number. So one, you have to allocate production. Oftentimes, the operator hasn't told you, they don't all work together to name the reservoirs and say, you know, this is exactly what I was targeting within this zone. And so we do a lot of work on the back end looking at drilling surveys and determining, okay, what zone were they really targeting so we can compare like for like. What this chart shows you is the blue line here is the average well performance since 2012 in the Delaware Basin. This is actually Reeves County in the Delaware Basin. Typical well has come online at about 600 barrels per day, declines out. The top line is the Wolfcamp A, or transition zone, in just 2017. So that's the average. That was about 70% of drilling targeted that zone in 2017. And then these two bottom lines are the Wolfcamp B. So most operators are including these Wolfcamp B locations in their inventory that they'll drill. But 450 barrels a day isn't 700 to almost 800 barrels a day. So if you take an average, you know, depending on how you look at it, if you're not looking at the reservoir specifically, if you've averaged, and again, let's go back to what's the purpose? You don't necessarily have to go to this granularity in every forecast. What's the purpose of your forecast? You can get very different numbers depending on how detailed you want to be. The reality is there might be, this isn't the exact number, there might be 100,000 locations in Reeves County, and 30,000 look more like this, and 70,000 look on like this lower side, and actually a little bit lower because the plays get even gassier as you move out of you're deeper in the Wolfcamp and into other plays in the Permian. Full development looks different as well. We actually haven't seen an operator step out and fully develop leases They'll talk about cube designs and drilling 20 plus, 30 plus wells. We'll see what that looks like. There's a risk to putting that much capital in the ground before you get first production. A lot of these companies need cash flow, and it's really hard to go invest $300 million before you see first production. So we'll see how that evolves as well. Maybe the bigger companies can drive that. And then productivity. I have gotten more questions over the last 3 or 4 years from different forecasts that say, your forecast is 5 million barrels a day, and so has a forecast that's 10 million barrels a day. Why is their forecast 10 million barrels a day? And I go, well, I think you should probably ask them. I don't know why their forecast is 10 million barrels a day. But in probing and digging, one of the big things we would see in those really high forecasts is productivity assumptions. So if you look at how the average well in an area has performed, let's call it 2017 versus 2013 or 14, you can easily come up with numbers and say, well, wells are 30 or 40% better today. What we would say, so the raw data would tell you something like 10 to 20% better per year. Well, if you extrapolate 10% better per year, that means 1,000 barrel a day, 1,500 barrel a day well today is a 3,000 barrel a day well 6 or 7 years from now. And we kind of go, well, I'm not sure how that works. That sounds a little bit like a stretch to us. Doubling production, we haven't heard of that technology. And so, but if you assume that type of productivity, you can get there. Well, we drill down a little bit further and we normalize for operators, we normalize for location. You look at how they're drilling longer laterals, maybe in some instances, different completions today. You normalize for all those things. And to us, it looks like the average operator or the kind of best-in-class operators get something like 1 to 3% better per year than what we would have expected. Absolutely, at a macro level, are they producing more barrels for lots of different reasons? But on a normalized recovery basis, it looks like the best guys doing the best they can are doing something like that on a normalized basis. You compound it and it can be very misleading. Where are the constraints? I think we'll talk about infrastructure constraints later in the day. Artem talked about some of them, so I won't dwell on those. But the reality is, coming out of the downturn and then getting back to high levels of activity, we're more likely to see average degradation in terms of you're stepping out into second-tier areas. You're losing time and people. And what I mean by that is they're busy. They don't have near as much time to design the wells, to make sure they're drilled exactly right. Things are overlooked. You can't staff as well. Planning, it gets harder as you're doing more and more. So as you come out, you're likely to see the opposite be true. If you look at the very high-level macro numbers, you might say wells are smaller today than maybe they were 6 months ago. It's largely a factor of where you're drilling, but they very much can be. And then a U.S. tight oil, what if? One of my colleagues, Robert Clark, published this a few months ago, and it garnered a lot of traction. And really, he started this analysis with the idea of, all of these, there's an exuberance phase in all of these plays, and not many of them, there's something that gets in the way, whether it's infrastructure constraints, it's prices, it's maybe more technically challenging. The Haynesville was more expensive than the plays that came behind it, and so forth. And so he looked at, I want to really dive into some of the technological improvements that we're seeing, and then also where we're seeing big problems. And as he got into that research, very quickly realized there are lots of little things on the technology side, and we really need those little things to add up to a big number, or all the risk is really on the other side. Mother Nature wins out at some point. These rocks can only yield so much oil. And so it's somewhat asymmetric. Again, it's hard to forecast technological advances, right? So there could be a step change. There could be something that comes that makes a big difference. So in terms of the sensitivities of the work he did, it was about 500,000 barrels a day on the upside. Looking at, okay, wait a second, if you use diverters, smart pipe, you land in the right zone, basically if you drilled wells and completed them perfectly, what kind of uplift do you get? It's 10, 15, 20% maybe. And that leads to something like a little 500,000 barrels a day higher in our forecast. On the other side, Frank mentioned frac hits and parent-child well relationships, and we began diving into our data that we have on similar completions and how infill wells are performing compared to the first wells on a lease. And you very quickly see it's at least 15%. And in many cases, it's 20, 25% type degradation in child wells. I'll say this, from an economics perspective, oftentimes they're just as good. You have sunk cost, you have people and facilities in place. You don't necessarily have to recover as much oil in well 3, 4, 5, and 6 as you did in well 1 to make them economic. So it's not an economics question, but it is a question about the amount of oil that's going to come. When you overlay that on our expectations and you say, hey, you know, by 2020-ish, you're kind of only drilling infill wells. And if all these wells are about 15, 20% smaller than our expectations, you actually peak much sooner. You know, it doesn't look like a decade of growth in the Permian. It looks like something like 5 years. Again, just another way to think about it. But as you're taking that snapshot of your forward-looking view, what feeds those expectations? You know, if you don't believe in technological gains, well, then you might be very skeptical. If you do, there's still more room to run. You know, in terms of technology, I mean, lots of things that were touched on in this, longer laterals, cemented liners, you know, things that we've already seen, geosteering, downhole diverters, frac complexity. We're seeing micro proppants used more and more. High efficiency lift, you know, that doesn't just improve the initial production, but the long-term production profile of these wells. Fiber optics, and then also, I think Robert will touch on a lot of these, you know, in terms of time-lapse geological modeling as well. And then last slide here, you know, I've mentioned this a couple times, you know, purpose really drives needs. The considerations are endless. You know, we have a model with 16,000 inputs. That sounds a lot more complicated than it really is, but you can pull that many levers in it. And at the end of the day, your convictions drive what you believe about this supply forecast and other supply forecasts. So what do I think it will hinge on? Will it hinge on infrastructure over the next 12, 18 months in places like the Permian? Artem even mentioned if one of those pipelines doesn't get built on time, it causes some problems in the Permian. Macro and corporate assumptions. What's implied versus assumed? Will the capital flow? What is the cost of that capital? That's before we even begin to talk about behavior. You know, today, where companies are being pressured by investors to actually return some money to shareholders, that's not necessarily natural for a lot of these U.S. independents who have spent what they have and some for about 10 or 12 years. So that's a big shift. You know, what oil price are you assuming? You know, oil price doesn't just change activity. It changes psychology. I mean, one thing we talk about a lot, I mean, we think longer laterals are an important story for the future. They're also mechanically more risky. A company would prefer to drill a 5,000-foot lateral. They know they can get off a better completion in a 5,000-foot lateral. But you know what? If oil prices stay $45, $50, they'll take the risk, and they'll drill those longer laterals. And they'll have to figure out how to make them work. So laterals are probably longer in a lower oil price assumption. So there are things like that that move. You know, it's not just activity. Well design and technologies, granularity in modeling versus feasibility. You know, back to that purpose. Today versus tomorrow. What do we know today, and how accurately can we predict tomorrow with what we know? Will markets cooperate? Back to some of the infrastructure things, but also demand. Is demand there? Other external factors, environmental and geopolitical, rigs versus completions. You know, 10 years ago, you really just followed rigs and you used a 2 to 4 month lag and said, well, that's what production is going to be. And today, it's all about completions, as Artem mentioned, being the driving factors. And with that, I'll stop and I think turn it over to Robert, and we have questions a little later.
Okay, let's see what happens. Right. Good morning. I'm Robert Kleinberg from Schlumberger. Always a pleasure to be here and talking about one of my very favorite topics, which is long-term outlook of U.S. tight oil. We've heard the title of the seminar today is short-term, but I'm going to look 5 or more years into the future and just see what the prospects are for U.S. tight oil production. This is some of this was presented to the OPEC technical workshop on U.S. tight oil that I attended with Marianne back in November in the run-up to the ministerial. Other parts of it are new material. So first of all, I think almost all of you are familiar with Schlumberger. It is the actual provider of exploration, drilling, and production services to the oil and gas industry. We are the people that do the fracking. The lower right-hand corner shows a typical Schlumberger frac spread. This is from Greene County, Pennsylvania. That's our equipment, our people, our fluids. We design the jobs and execute them. I do want to caution you that what you're going to hear from me this morning is my opinion. It is not necessarily the opinion of Schlumberger management, although it is informed by my 38 years with Schlumberger. Just putting this back up to just show how surprised we can be by the oil industry. This shows oil production from tight oil plays from 2010 to 2015. The actual is the solid line. The EIA Annual Energy Outlook 2011 forecast is shown in the dotted line. EIA actually provides this data to us at this late date. I commend their honesty. This graph has been put up many times and always excites a great deal of merriment. But the point here is that that actual curve was completely unexpected. It did not fall within the technology upside case, or anybody's technology upside case. The idea of horizontal well construction and massive staged hydraulic fracturing was in oil plays was really completely unanticipated as late as 2010, except maybe a few places. And so this was a real surprise. And what I've asked myself many times as a technologist is, can we expect this kind of surprise again? And I've really sort of searched my soul, looked at the technology, and what I'd say today is I do not anticipate any surprise of this magnitude. But there's a second question which is equally important, which is, can we maintain our production of U.S. tight oil in the face of inevitable depletion? And that's really what I'm going to talk about today. So to answer to get some insight at least into the question of whether we can maintain production in the face of depletion, I think it does help to look at some history. And the picture on the right is a picture of Spindletop, drilled in Beaumont, Texas. It drilled in January of 1901. It blew out at 100,000 barrels a day from a depth of 1,000 feet. Pretty remarkable. And this sort of was the onset of the big Gulf Coast oil play of the early 20th century. There were similar plays in Baku, Sumatra, and so on in that period. Now, as I say on this slide, the important thing to know about this is that this well was produced on primary recovery, which leaves 90 or 95% of the oil in the ground. And that's okay. I mean, you're leaving a lot of resource in the ground, but you are producing more than enough oil. I think oil was maybe 10 cents a barrel in this era. And people were still making money at it. So that was good enough. But, by the 1920s, people needed Schlumberger because all the gushers in the Gulf Coast and Baku and Sumatra had run dry, and now we're getting to the harder to get out oil. And so what was the response of the industry to that crisis? Well, industry developed a myriad of ways of getting past primary production. The primary production boxes, I'm not going to describe every one of these boxes, don't worry, but primary production, which is based basically on the natural pressure of the earth and what's called solution gas drive, which I'll talk more about later, is in the upper left-hand corner, sort of the white boxes. Secondary recovery is water floods and pressure maintenance, shown in the blue boxes. And basically today, every conventional well in the world, almost every conventional well in the world, is put on secondary recovery as soon as they're drilled. And then there's tertiary recovery, which is used in special circumstances and so on. And there's a whole toolbox. So in other words, the toolbox for conventional oil is pretty full, pretty well equipped. And now we expect to produce 40 or 50% of the original oil in place. And that's considered satisfactory today. Let's look at the tight oil situation. A lot of white space. Secondary recovery does not work. Water flood doesn't work because the permeability of these tight oil formations is too low. Pressure maintenance doesn't work because the reservoirs are not gravity segregated. So all the blue boxes are gone. So we have to think of something else. And so we're thinking pretty hard about how to enhance recovery. And we will need to do that at some point, because at some point we will no longer be able to rely on the, what I might call, tight oil gushers, the plays that produce at a satisfactory rate just on primary recovery, just based on the natural pressure inside the earth. So what sort of opportunities do we have? So I'm going to talk about three approaches. This is not an exhaustive list, but it's sort of representative of the way we're thinking now. And it'll give you an idea of kind of what the upside is in terms of maintaining the viability of our production. So one is more efficient hydraulic fracturing, one is permeability enhancement, and the third is tertiary recovery. So let's look at more efficient hydraulic fracturing first. Now, this is an experiment I was actually involved in personally, where we measured the organic matter along the horizontal leg of wells drilled into a tight oil play. And what we measured here was the amount of organic matter, which varies along the well bore. These wells are about a mile long. And if you just, and then in a separate study done somewhere else, but similar idea, if you just take a well like this and fracture it at even intervals, which is common practice today, it's found that generally speaking, a third or so of the perforations are completely unproductive. So you're getting all your production from 2/3. So in other words, you're sort of wasting 1/3 of your effort. If you actually go and make measurements like this in the laterals, you can basically, and say, in this case, fracture where there's high organic matter, which often correlates with better production, not always, but often, you can get the unproductive intervals down to 10 or 20%. So that's really a big improvement. And you might ask, well, okay, I mean, this slide is labeled ready-to-use measurement technology. We can do this today. And you might ask, well, why aren't people doing it? And the reason is that Schlumberger charges a lot of money for it. It costs us a lot of money. I mean, the big problem is really conveyance. Getting instruments down and pushing them out along horizontals takes some elaborate equipment, procedures, rig time. And clients feel, well, hey, you know, just like back in the old gusher days, we don't need to do this. We don't need to pay Schlumberger the money. We don't need to take the risk that it actually won't work as well as the sales guy says it will. So let's just continue doing what we know will work, which is the present paradigm of not making measurements in horizontal legs. But this is something that is out there, and when our present sweet spots, whatever, deplete, people are going to be forced to make more measurements, as they were forced to make more measurements in the late 1920s and 1930s, when Schlumberger really became a commercial enterprise in the conventional plays. So as I said, this is ready to go, ready to use today. And this is one thing that gives me confidence that we will be able to overcome our depletion problem. So let's look at another example. This is something that, again, I had a role playing in the lab. It has not been field tested, but it's been lab tested. And what you're looking at on the left is a scanning electron micrograph of a gas shale rock, actually. Probably many of you are not used to looking at these pictures of rocks, but the light gray is mineral matter, could be quartz or carbonate, not unproductive, doesn't have oil and gas in it. The dark gray is organic matter, and that's where the hydrocarbon comes from. And then the black is pore space. And in this case, the pore space is not through going. So in other words, it does not give you a channel for production out of the rock and out into the fracture and then onto the wellbore. So that's why these rocks are really tight. They do not produce rapidly. They leave a lot of oil and gas in the ground. So what we did was we took some organic solvent and treated the rock, and the result is on the right. And now you see that dark gray organic matter has now looked, I don't know if I can pointer. Doesn't really work very well anyway, but the piece of organic matter that was sort of very solid and actually clogged pore space on the left is now sort of very depleted, cracked, and you can see that now there are more porosity, and that porosity is through going. So this is a way of treating the reservoir to enhance the permeability and allow more hydrocarbon to flow out more and faster. Again, so you might ask, Bob, you've lab tested this, like, what's going on? Why no field tests? And the reason is that, again, clients are not terribly interested. This is a high-risk operation. Nobody wants to be the first on their block to try it, and with high costs and uncertain results. So not economic in today's circumstances. But it's out there. This is technology that is sort of ready to be tested, I would say. That's what I would characterize this as. And we've got a portfolio of this sort of stuff also. Let's look at tertiary recovery, and this is kind of the most interesting part of the story. This has gotten a lot of attention. I think the most promising approach, I've been saying this for a long time, other people seem to be now agreeing in larger numbers, is the best approach seems to be what's called cyclic gas injection. Now, when you produce these tight oil reservoirs, it's sort of like, and maybe some of you have heard me say this before, it's sort of like popping the cork on a bottle of champagne. Basically, you've got, the champagne has a lot of dissolved gas, it's carbon dioxide, which dissolves readily in water. You lower the pressure by popping the cork. The carbon dioxide comes out of solution, creates bubbles. You get a whoosh of gas and liquid that pops out, sprays your guests, and then the gas is all gone, and you've got the bottle of champagne. Probably 90% of the champagne is still in the bottle. This is what's called primary production. And now, of course, you just tip your bottle of champagne into the guest's glass, if he hasn't already thrown it at you. And that's primary production. And you can tip the bottle, but you can't tip a reservoir. So once you're done with that initial whoosh, we abandon reservoirs, basically. So the idea here is, well, can we repressurize the oil to get a second go at it? A second, repressurize it, redissolve some sort of gas into the liquid, restart that primary production, and then lower the pressure, and again, sort of get another whoosh of gas plus oil. And there has been many academic and theoretical publications on this. There's been lab tests. The one big field test that has been advertised has been by EOG in Eagle Ford. Very, very few details have been disclosed. And you know, those of us in the industry have sort of been following this very carefully, waiting for that technical publication to come out. What the heck are they doing? Because they are claiming a 30 to 70% uplift in a limited spectrum of wells, but it seems to be successful. They're talking about fairly large 70 well programs and so on and more. So the one thing they will tell us is that they are injecting field gas. Okay, so I think field gas makes sense, cheap, available. They own it themselves. It's on the site. It's on the lease. Of course, that's what you're going to do. It's the simplest thing. Carbon dioxide would probably be better because carbon dioxide is very soluble in crude oil, and that would be a sort of better medium, but carbon dioxide's expensive. Ironically, the oil industry is carbon dioxide constrained. with respect to our operations, strange as it may sound. But okay, this sounds interesting. But then I sort of looked more closely at this, and I thought, okay, what are these solubilities? And sure enough, when you go back to the literature, excuse me, which I've done, you find that carbon dioxide does dissolve more readily in crude oil than methane. Fine. Thus substantiating my suspicion. Carbon dioxide would be a good thing. But you also find that ethane and propane are even better. And now you think, what is field gas? Field gas is exactly what's coming out of these tight oil plays, which is heavy in natural gas liquids, ethane, propane, butane. So I now believe that EOG might be re-injecting the optimal mixture to produce a tertiary recovery by cyclic gas injection. So very clever. Now, this is completely unsubstantiated. I've not talked to anybody from EOG. I doubt they would talk to me. But I think this may be one more clue as to what the heck is going on, and this would be a very interesting way forward because, again, field gas is on your lease. You don't have to build a CO2 gas pipeline to you, so that sounds very, very interesting. Just like to say one more thing about natural gas liquids, and Rusty's here, so this is one of his favorite plots, I'm sure. The production of natural gas liquids has increased apace with tight oil. It comes from the same place. It's co-produced. So there is no lack of ethane and propane out there. We're exporting shiploads of ethane to foreign petrochemical plants. So any place where you don't have your own or you've already played out, and gone away, you can come back and probably get ethane and propane pretty darn cheaply to restart your process. So it's not just for an ongoing operation, but you can even go back to old operations and maybe restart that way. So that's kind of a very optimistic point of view. But I really do think, again, I'm going to just reemphasize in my summary that basically we are now producing from sweet spots using primary production, just like the oil industry of 100 years ago. And just like 100 years ago, our recovery factors, which is the ratio of estimated ultimate recovery to original oil originally in place, is in the 5% to 10% level. But there is a large technology upside, which might include state-of-the-art well construction, reservoir contact paradigms, enhanced oil recovery, which will basically enable us to sustain our production long past where we think might be possible based on current technology and current practice. So with that note, just end and looking forward to the discussion. Thank you.
Well, this is terrific. So Artem, RT, Bob, this is exactly what we wanted to do in the setup. We're going to open up for questions. We've got about a half an hour questions. Bob, one of your slides, I'm going to start with you. It struck me on the change, if we go back, and John Guy's sitting here in the front row, when we did the hard truth study, which the NPC put out in 2007, so the data and analysis was 2005, 2006. So we're more than a decade beyond it. That shale gas from source rock was a white paper, right? We were just at the point we were just starting to see that. And when you look at the exponential growth, the amount that we have learned, we're still looking at the rocks. It's not homogeneous. When we looked at what there was 28 plays in 31 states, 7 account for 95% of the production growth. So they're not all the same, and the Permian is stacked, so there's special characteristics. But as we go down the line, if you could all comment on some of the lessons learned over that decade period. So in our workshop period, we picked up, for example, you talked about extended reach laterals and where the inflection point is that beyond which it doesn't make a lot of sense to do certain things. There's producers, small producers have come in and talked about, geez, maybe one of the mistakes we made in the Eagle Ford was that our well spacing was too close. And we're seeing examples of well interference. So I'm going to start with you, Artem, and kind of work our way down. lessons learned over the years that we can actually use. Because the other thing that strikes me is even as we have these peaks and declines, we're now building up with tens of thousands of wells, these tails, that to the extent that you can still keep evacuation routes open, that's a base of production going forward, right, until proppants give out, so, and degradation of the wells. So what does it look like when, take a look back and then a step forward?
Yes, I think this is a really good question, actually. So if we actually return to the example of Eagle Ford, when we looked at, if we look right now at our production projections for Eagle Ford 4 or 5 years ago, we would actually find out that many of these wells, they really underperformed the initial decline curves. So many operators faced this. So this is one part of the story. But second issue, which Eagle Ford was really facing in the last couple of years, were disappointing results on the infill completions, which were really, spaced really tightly. Sometimes they now try to do 2 zones in fairly thin layer, which was historically developed as 1 zone. So many of these wells, they still achieve fairly decent peak productivity, but production profiles, they literally collapse. So compared to some of the parent wells, many of these things, they were really not embedded into initial production projections, even on an E&P side. And now with this most recent news also about stag play, when Continental sort of revised down their number of wells per spacing unit in the most recent communication. It was quite a negative reaction on the market. So we think that stories like these, we will see them more and more frequently in some other places as well. So there are some things, some downside risks, which will definitely materialize. However, we just observe so many things, so much unlocked potential, which hasn't been fully realized yet. And in most cases, it will just offset positive surprises from shale. They will just offset all these negative stories. So we don't really think that this negative news, which really affect base decline projections, they will be important as we move 3-4 years into the future. But as I mentioned, like historically, we definitely observed, some of this underperformance.
Yeah, my job, I think one way to describe it has been a lot of listening to people to try and figure out what they're really telling you. And the industry, I've continued to be, and I don't think it's changed. I think there's this somewhat a miracle in hydraulic fracturing and these long laterals that work, and we get oil out of a reservoir, and we know it's coming from, the Eagle Ford and maybe the Austin Chalk above it or nearby sources and reservoirs, and we know that's contributing to it. But I still think we know very little about what's actually happening downhole. We know we're creating artificial fractures. We know where we're producing from, but what's really happening over time. And part of that's economic. I mean, you have to make money. I mean, these companies don't work if they don't make money, so they can't afford everything. Oftentimes, they'll drill a few wells and they don't even have to do a lot of the measurements when they're drilling, because they know, we know what the zone looks like. If we start seeing these cuttings, we just steer a little bit differently and we stay in zone. The other thing I would say about well spacing, it's also true that no interference is bad. If you're drilling, completing every well and you're not, getting some interference or communication, you're too far apart. That's not optimal either. So you need to see some of that. There's a healthy number. And we like to say, and again, going back to the simplicity of messaging, this is just different. Maybe the conventional world had success 20-40% of the time, depending on where you were. And unconventionals, there are very few dry holes. Typically, they're mechanical dry holes. You've failed somewhere in the process to really drill an effective or complete an effective well. So you get few dry holes, but you do get a lot of variability. So you have bad wells and you have good wells. And the important thing is these guys have to learn from those bad wells. And you look at the good companies, that's what they're doing. Yeah.
Well, I have 3 issues. 2 are sort of uphole, 1 is downhole. First is obviously pad drilling. When I look at the examples, our early shale gas examples from sort of mid to late 2000s, we were drilling basically along a road. A mile would be developed by 5 or 6 drill sites spaced evenly apart along one edge of the section. And obviously pad drilling is a huge improvement there. And basically what pad drilling does is not just, sort of less environmental impact or footprint or something, but it allows you to make your supply chain much more efficient. And what we saw in that period was that whereas the exploration geophysicists used to be the gods of the oil industry, now the supply chain managers were the gods of the oil industry. And we're still seeing consequences of that today. Second, as a result of this pad drilling, our frac fleets could actually stay in one place for weeks or a month at a time. And that was a whole different paradigm in terms of our operations, because we were used to going out to a job fracking, in a day or two, and then leaving, coming back to the base, sort of overhauling the equipment, sort of washing everything and changing all the O-rings. And now all of a sudden we're on site for a month, and that really required sort of very different approach to equipment maintenance, design, and in fact the whole uphole design is in the process of being changed. So that's something that's maybe a little bit inside ball, but that's certainly been important for us. Third thing, downhole, a really important trend, which is not sort of mentioned often enough, is tighter fracture spacing. So we started out with 200 or 300 foot maybe fracture spacing, maybe 6 fracture spaces, 6 fracture sites in a several thousand foot lateral, and people did that because our geomechanics gurus told us there was going to be what's called stress shadowing, which means when you open a fracture, it sort of makes the rest of the formation harder to fracture, so people didn't want to fracture too close together. We quickly discovered that we were way, way too conservative in terms of fracture spacing, and that has had a huge impact on the efficiency of producing these formations, both oil and gas. So that was a huge lesson, which is not often recognized sort of outside of technical circles.
Excellent. Okay, so I have a few more questions, but I've been told I can't hog the microphone. So except for one thing that I will say, and we've been talking to Rusty about this for a couple of years now, we really do need to do a more in-depth look at liquids. The liquids-rich gas plays, the parts of liquids now that are circumventing the refinery stream and going straight to product. For OPEC, the notion that there's 6 million barrels a day of liquids that aren't counted. Our liquids production now is over 14 and heading towards 20. So at some point we will come back and deal with that. So I've written a note to myself. Questions from the floor? We got a big group. Please wait for the microphone. Identify yourself and your affiliation. And to the extent you can make a comment, but put your question in the form of a question. So we're going to start with David. We'll go to Alulu and come back to Marianne, and we'll take the first 3 that way.
Thank you. David Knapp, Energy Intelligence Group. I have a footnote for Artem, and then a question for RT, and then one general comment. The footnote is when you were talking about lead times, that I think one thing that really needs to be added to that is the where and the what. I was talking with an oilfield service guy yesterday, and he said it's all about the Chinese. It's too expensive. I'm not going to do any new build equipment because it costs too much and it takes too long. And he didn't say 6 months. He said it's 9 months, and that's if you're lucky. So that has something to do with it. And in fact, that's my second question. This is to RT. You were talking about attitudes and the importance of attitudes. I totally agree with that. But the drift of it was that you were talking about the attitudes of the drillers. And I think or the attitudes of the E&P companies, which was what was sort of implied by that. And I think maybe the real key here is in the oil service sector, because you're going to need those guys to be doing the work. Robert knows that very well. And they're at a point where this guy I was talking to, who runs Canary, some of you may know, that he said, they got to give me more money. And that raises costs, that changes the economics, et cetera. The other thing is that when you look at the Eagle Ford, for instance, and the sweet spots and the possible deterioration and whatever, the other part of that, of course, has nothing to do with the technology or the drilling sector. It's about the financial health of the companies. And that'll be our next session, so I won't harp on that, but hopefully it was me, I coined a phrase called economic Darwinism in the shale patch. And we've seen a lot of that going on, both in the E&P sector and in the oil service sector. And so we're still recovering from that, and that really changes a lot of the economics, so that we will do next. Thank you very much, Frank. Great conference so far.
And give it to Alulu. Just pass it. Thanks. Thanks, Ted.
My name is Alulu, Fauzi Alulu, from Energy Forecasting, from EIA. Well, I've been running the Energy Forecasting Forum for the last 15 years. Artem, one question about, I know that Rystad has a large office in Houston, so most probably they are aware of the local community resistance on those kind of bottlenecks and what the operators and investors have in mind. That's, if you can really have some response to that. For TR, the type curve in Haynesville, it's really impressive, but I'm wondering if it was really put in contest because we have seen this kind of rebound since August, and we are looking at what happens to Haynesville, which is a dry shale gas, while the price of gas is not really that impressive, and here you have Haynesville rebounding. So maybe the issue of investment discipline could really explain who are behind this kind of abnormal phenomena. Robert, slide number 3, about shaming AEO forecast. I'm wondering what's Schlumberger forecast at that moment? Thank you.
I'll answer first. We don't do forecasts.
Those are tap shoes, by the way. Mary Ann, go ahead.
He's smarter than the rest of us. Haynesville, I don't think I made this comment, but we've seen kind of technology come full circle. You saw these bigger completions really start in the oil plays. And then as they were introduced into the gas plays, they've been successful. I mean, these are much bigger completions. That was largely driven by an operator group that's new as well. You know, we've seen a lot of assets turn hands in the Haynesville. And, you know, it's core to those guys. You know, it's all they have. They're going to do everything they can to make it work versus sitting in someone's portfolio that maybe doesn't compete with other options. But we think there's a lot of the Haynesville that makes sense in this gas price, you know, about where we are today. There are wells that make sense on 250, kind of in the best area, but 275, 3. There's a lot of the Haynesville that looks decent.
Okay. Mary Ann.
There's a lot of hype in the media about data analytics, and before Robert starts shaking his head and saying, no, it's not a big deal, I define it more broadly as putting sensors downhole and using all of that data in your operations. So I would like the panel's view of how much you think you can go with this, and is that the next phase of technology when we've exhausted what we can get economically from primary production? My second question is, what does the panel think about applying some of what we've learned in unconventional production to what we view as conventional wells? Is there any way we can use some of these things to enhance conventional production?
Excellent question. Go ahead.
Yeah, I'll probably comment first on this one. So in terms of, you know, potential for the efficiency and technology gains, I think we're still, like in many areas, we're just in a very early days. So as Robert mentioned, for example, you know, on the frac spacing, typical land for the stage really was reduced from 300 feet or even more back in 2011, 2012. Right now we're at 200 feet on average across the entire US shale, but there are a lot of operators who are trying to do 120 to 150 feet per stage. So there is a lot of potential. Even when we reach a certain limit on the lateral length, we reach a certain limit on proppant density per foot, there is still a lot of work to be done on the stage spacing and the number of clusters, perforation clusters per stage. So we haven't seen this inflection point in most of the states. Even if you take Bakken, which is really mature, there were a lot of structural changes in the well design over the last couple of years, demonstrated by all dedicated players. So I'm not even talking about places like Delaware, Stark, or even Midland, for example. And when it comes to your second question regarding the applicability of some of these unconventional techniques on some legacy reservoirs, we have already seen a lot of these things happening. So modern fracking techniques, for example, they were applied on some of the reservoirs which were historically developed in a more conventional way. For example, in the Permian Basin, if you go to Utah, to Uinta Basin, or Pinehans Basin, there were a lot of changes. There are some issues, some constraints related to that, because sometimes some of these frac jobs, they are actually performed by really old, inefficient frac spreads with very low horsepower. So sometimes it's very difficult to actually conduct a proper high-density frac operations in these areas. And right now we're in the situation when we're really short on the supply side. So when we talk to some of the operators who actually are active in basins like that, they're really eager to get one of these more efficient frac spreads right now, but they just face quite significant, cost spikes when they try to request one. So they're struggling to find service providers who are actually willing to reallocate their pressure pumping equipment in some of these places. But in long term, of course, there is a quite significant potential of modern fracking technique in some of these conventional reservoirs.
We think if every well was optimized at something like 10 to 15% better than what we see on average. The reality is for some operators that's 20 or 30% better, and for some maybe they're consistently doing really close to what we think is as good as it gets. The reality is it's hard to predict innovation, so it's hard to put a number on what the potential is, but there are some things we know. I mean, where you can make chemical diverters work and you're taking mechanical risk out of the hole, that's very valuable. Automation above ground is already helpful. A guy can service 50 to 100 wells typically. Today with automation, maybe that's closer to 1,000 wells because he's getting alerts and it's telling him, hey, you're running at a higher RPM or hotter than expected on this pump. You're gonna need to check this in the next 2 weeks, and he can schedule it. So we're seeing some of those things already. In terms of unconventional technology into conventional, absolutely. I mean, you're seeing all of these conventional fields get extended. You're seeing really in the last, call it 3 or 4 months, a lot of the rig count growth has been private companies. They're a little bit, maybe they don't have access to the capital markets these public companies do, so they're a little slower to respond, but they're ramping up as well too. I mean, $60 oil is a lot better. They actually have some money to put to work. And so you're seeing them act, and many of them are acting in conventional fields. That's what they hold. And they're drilling horizontal wells for the first time.
Okay, well, first on data analytics, Marianne knows I'm a skeptic. I'm kind of more of a hardware guy, but that said, Schlumberger is reorganizing its entire operation around a data analytics focus, which is interesting. It's also very controversial internally. Obviously, we are going to do our best to execute that vision. And there is upside. Right now, what we're seeing is, I'd say, what I would characterize as sort of small ball things like predicting when you might have to pull a downhole pump or something like that. That's a nice application. Somewhat more important is the idea of drilling advisor, which uses a lot more sort of smarts to help the drillers drill more efficiently, and that is important because we've lost a lot of people out of our industry in the last few years, a lot of experienced people. That drilling advisor could eventually become a drilling autopilot, and I think that is a foreseeable technology direction. As far as larger issues, I'm going to leave that for the future, and maybe we will be seeing some much more exciting developments in terms of reservoirs, but like I say, I'm a bit skeptical personally, although I do not speak for my management in that case. With respect to using unconventional processes to exploit conventional reservoirs, yes, well, Permian Basin. Sprayberry was well known as the world's largest completely uneconomic conventional reservoir. And people are drilling vertical wells, maybe with a fracture or two. And then when the new paradigm came along, all of a sudden it became one of the world's most important plays. There are other low-quality plays out there. I don't have a list with me, but we can be assured there are. However, where you have a high-quality reservoir that's already producing 50%, fracturing will not help you. You can't really fracture a high permeability reservoir. The fluid just goes into the formation. So, but I would be looking for unexploited, uneconomic, low-quality reservoirs like Sprayberry.
There you go. Okay, we're going to.
I have a simple question, which is, given the outlook, what you predict what a well would recover, and over time, as a general rule, when you look at the well productivity, how much it produced, did it turn out to be about the same as what you predicted, or generally better, or generally worse?
This is a question for Bob. And it's a little more in the technical detail, but I was intrigued by your presentation for Jim Sluice, National Petroleum Council, but on your field gas reinjection idea. But it strikes me that in largely you're temporarily using that field gas, because then it could later be recovered. And so that makes it very intriguing in that you're not actually like other enhanced oil recovery foods. So anyway, I just thought that, and would just wanted your confirmation that is, I assume you lose some, but be interested in your thoughts on that.
Talat Dafer from SABIC, a global petrochemical company headquartered in Saudi Arabia. This is a new technology, as we hear today, using the gas or the carbon dioxide to have more oil or gas. Is it only for oil, or you can have gas? This is the first question. And the second one is, don't you think using carbon dioxide or gas, natural gas or whatever, to have it more, don't you think as a petrochemical we can really use this gas you're gonna try and even make it more expensive to have the second round of drilling to extract oil or gas? I hope it's clear. Yes. Yeah.
Yeah, I just want to make sure I do understand the question. So, are you asking whether the gas is lost in the process and not fully recovered? Was that? I'm sorry, I didn't quite.
You are using it.
Yeah.
As you said, it used to be 90 to 95% leak, and with the new technology, now it's up to 60%. You can take oil from by using this method as a gas or carbon dioxide. You will produce even more for the second. I know it's going to cost even more, but at least don't you think the price will make a difference, because the first one is going to be cheap, but using gas or using other technology, it can be even cost more. This is the first thing. And petrochemical, as you know, the feedstock for petrochemicals is gas. So don't you think using gas to petrochemicals is rather better than using it to have in this technology?
Right. Yeah, okay. So for one thing, you never get as much on the second time round as you do on the first, and even less on the third. So what EOG has told us, one of the few things they've told us, is that they get about 30 to 70% uplift. Now, it's not clear whether that's just on one cycle or multi-cycle, and how long it takes exactly. So it's not that you're going to go from 5% to 60% or anything like that. You're going to go from 5% to maybe 7%, hopefully. So that's kind of the magnitude of the gain, and that's why I say that this is not going to produce a huge surprise, as the type we saw in 2010. To sort of return to Jim's question, Jim Sloot's question, yes, you might lose some gas, but you'll substantially get most of it back, and then you can sell it to Rusty. No, so it does come back, and then another, the third question, I guess the second question, is whether there's a tertiary recovery of gas reservoirs. The answer is no. As far as I know, practice is you just let the balloon deflate, and that's the end of it. There's no repressurization. It doesn't make sense. So I'm open to somebody correcting me, but that's the best of my understanding. I've never heard of a secondary or tertiary recovery of gas.
So on the EOG question in the Eagle Ford, I mean, I think if they somewhat imply, let's just call it 15 to 20% recovery in their best wells, so 30 to 70%, you're maybe getting up 25, 30% type recovery number in EOR. So maybe at best it's half as good as tertiary recovery in conventional reservoirs. And then on the recovery, the first question, the recoveries question, Bob, I don't know if you guys have done technical work on that. I mean, we look and we see both. I mean, we see individual wells that really outperform what you would have expected and some that don't. In general, though, we're seeing recoveries go up. I mean, these bigger completions look effective. I mean, you're bringing some oil forward and also you're recovering more, at least what our statistics tell us. I don't know, Bob, if you've done technical work.
Yes. I'm sorry, yes.
So he was asking about recoveries over time. If
Not the recoveries over time going from well A to well B to well C. I'm talking, look at well A.
Yep.
You estimate what the recovery was at the beginning, okay? And then you look at how the production profile plays out. Was that generally running about what you predicted, or running somewhat higher, or running somewhat less? So in other words,
Yeah.
if well B were better, then I would look at well B as a separate question.
Right. And that's what I was saying at the beginning about we've seen both. I mean, we're individual wells. It kind of goes back to the variability comment I made earlier that, you know, a lot of these wells, there's maybe more variability than it seems. And you'll see these wells that maybe hit natural fractures and so forth that really outperform, and then some that underperform. I don't have a general rule of thumb off the top of my head. I don't know, Artem, if you might have a number.
Well, I could probably comment on this one as well. I would say as long as you have maybe 16 to 18 production data points, monthly production data points, then your EUR figure really converges. So unless you have a sudden interventions, you know, refracs or anything like that, then you can predict EUR with very high degree of confidence. If you only look in, you know, at the first, if you only have 3, 4, maybe 5 months of production, there could be a lot of factors contributing to evolution of future production, because it is largely the situation that in the first 5-6 months you can get any production profile as you want. It really depends on your well configuration, intensity, but also a lot on the exact completion technique. So we saw many cases, but and some of these decline curves, as I mentioned earlier, in Eagle Ford for the wells from 2011, 2012, some of these wells are really underperformed the expectation which we had at the time being. By now, I think we have collected sufficient empiric data to come up with more accurate predictions. So let's say last 2 years, we didn't see sudden surprises as long as you have few monthly production data points. And if I may, I could also comment a bit on the gas question. In case of EOG, as was mentioned, it is really an economic decision. So if you are really able to increase oil recovery by 15 to 30%, it is more or less a no-brainer to actually use these gas for reinjection. And in fact, in some basins, so if this technology proves to be successful, we think it will be really important to start applying it in such places as the Permian Basin, because in the Permian Basin, we're just getting a lot of gas is really a side product on all these, modern liquids reservoirs. We're already facing a lot of issues with gas takeaway capacity. So in late 2018, we're actually hitting total existing infrastructure on the gas side, unless there are some the connectors for the pipelines on the Mexican side they're installed. So if this doesn't happen, we'll definitely see increased flaring in the Permian already, in 5-6 months. It is actually quite tricky in Texas because you cannot really flare a gas gas for more than 10 days after the well completion. But what you can do, you can get a flare-in permit, which will extend this period to 45 days, and the permit can be further renewed for a maximum period of 180 days, basically 6 months. Some operators, they're actually doing it already now on Delaware sites. I mean, they just have this rolling 6 months flared gas production from all new wells. And if we don't get significant expansion around mid-2018, we will definitely see quite significant spikes in the volumes of gas which are flared.
So I'm mindful of the time. I don't want to neglect that side of the room. If you've got a burning question, I'll be happy to take it. Okay. Someone up here. And then what we're going to do at the end of questions, we're going to take a 10-minute break and then reconvene. So we built some time in. Go ahead, please.
Thank you. It's Abdullah Lomer from Saudi Aramco. I know that RT, you have touched on this during your presentation, but really, if you could just sum up your key takeaways on the question, why do shale production forecasts diverge?
Wait, sum up the key takeaways from the presentation? Is that what? Oh, for all three? So, do you want to start, Artem?
Yes, I'll probably start. As RT showed, for example, it's very important to pick the right type curve. You can get significant difference. I hope no one is doing it the way basically you showed for Haynesville. Basically, no one is really using type curve from 2012 to predict productivity for the recent wells. But if someone does, of course, you can get arrive to a very significant error already for one single county. So it's very important to take into account all the latest information on the well configuration, well design sites, and what companies are saying when you predict production. A lot of discrepancies, we see a lot of discrepancies on the base decline. Some of these latest well completions, which are way more intensive, allow you to get much higher peak productivity. They also exhibit steeper decline rates, basically faster reservoir depletions. Sometimes there is a tendency, if you see the latest initial production rate, sometimes there is a temptation basically to just scale the entire decline curve by looking at the IP rate. This is typically a wrong way to do it. You always, in most cases, you'll get fast, steeper decline rates on all these most intensive completions. So it's very important to be accurate on the base decline. And the last, and I think the main driver, is of course the price forecast. Shale is still, to a certain extent, is a swing producer. It is able to respond relatively quickly, even though it is able to stay relatively resilient in the low price environment, as we saw in 2015, 2016. But when we talk about any high cases, it is really a big difference whether you have $60 per barrel price view or you have 70, 80, or $50 per barrel. So it's quite significant variability. So I would say these are probably three main drivers from my perspective.
Yeah, I'll jump through the main examples I used. Yeah, the Haynesville example wasn't illustrative, but it was basically saying, if you just look at what's happened yesterday and try to predict the future, it's really difficult. There are also some problems that are created in the way the data is delivered, even from public sources, and how you have to clean that up and think about, okay, wait, well 10 might be a lot different than well 1,000, and well 1,000 a lot different than well 10,000. And so forth. And then productivity was one of the examples I went into, and that we see, and again, it's just my experience, others are going to have different experience, but when I get questions about, why is this forecast so high or so low, oftentimes when you dive into it, it's something simple, like we assumed wells will get better, 5% better per year, and that leads to pretty big divergence in forecasts, as well as we're seeing Mother Nature, in well results today in terms of lower productivity from infill wells also. So in the short term, it may go the other direction, and somebody who's assuming it's going to go up and to the right forever, it creates a pretty big divergence. I don't even know if I said this, but the way I would sum it up, we look at data, we take the data, we take what companies tell us and what we can glean from them, and then relationships, and we build that into what we believe are tools and insight that help others make decisions. So it was really more just a few highlights of things that I've seen, that drive pretty big divergence.
Okay, my bottom line is that I'm an advocate for the high technology case that our friends at EIA produce. I think that's probably more on the right track than the more conservative cases.
So what we tried to do this morning and throughout the day is to put it in context, right? So we may give you, we'll give you definitely a more complete picture of what's going out there. In terms of a more accurate picture of short-term, I've always believed that the long-term game right now is a series of short-term games and strategies, right? Until we see where it pans out. Technology improvement's a big thing. Infrastructure is going to be a big play too. So the structure today was to look at the rocks, look at operational practices, productivity, where we're going on the technology. Second panel is the financial piece. So are you going to have the money and the wherewithal to drill the wells you expect to drill? And what are your expectations on this, right? How long can you, if it's value versus volume, do you continue on a volume track, or are you really looking for shareholder value? Or is there a mix of both? And then the third panel, what we really wanted to get to in the third panel is setting aside all of that. As production went down into the trough, when it was at the peak, we started building out excess infrastructure and takeaway capacity we thought we'd need. Then we had spare capacity. Now we've come back to where we were a couple of years ago, and we're going with incremental new volumes above that, which requires new build, additional storage, reversing pipelines, taking away associated gas, and now we're looking at the export market. So the third panel today is going to look at above ground issues, especially on the infrastructure side, but also community, societal. When we start talking about, when we looked at the Bakken, I'll take this a decade ago, there was 10 people per square mile. So a bad congestion day in the Bakken was a truck that couldn't get by on the road because bison were crossing the road. That's not the situation we have today, right? So when you're in Pennsylvania, there's 30 or 40,000 people a square mile. You can't do the same thing. So the concerns that people have on congestion, pollution, climate change, methane regulations, access, and then the other piece is on the export market. So we're now seeing, I think for the first time, even mid-sized companies that used to just produce their volumes and sell it to a local refiner have to think about, should I have equity participation in takeaway capacity? Do I need excess storage? Should I be talking to refineries and export facilities and sending now salesmen to foreign nations to talk about, geez, try my light oil? And where does light oil fit in the bigger mix? In some ways, I think we've actually been benefited by the fact that Nigeria and Libya were a bit offline. When other West African producers and MENA producers come back with more light oil, where's the home for U.S. oil? We'll get to all that today. So what we were basically trying to do is dispel some myths to the extent we can, incubate some new ones, and I think we've done that. We want to have a good discussion throughout the day. I'm going to actually ask that we take a 10-minute break so that you can engage the speakers, exchange some business cards as we go, and then we'll reconvene back here 10:45-ish, start the second panel. But please join me in thanking the speakers. I think it's an excellent start to a big day. Outstanding.